So generally speaking, the economic cycle, and I'll use the ISM survey, Institute of Supply Managers survey from the US as the best guide, has been subdued. So even though we've had equity markets and stuff very strong, the economy's been subdued. So normally a growing economy, you should see the ISM above 50. GDP's actually been reasonably good, but there's something going on in the kind of manufacturing sector that is still sluggish. So the cycle has still been relatively slow, which has created this bifurcation of like tech stocks, which are not based on, debt dynamics or real world expenditures. It's a very separate kind of cash flow that they're earning. The traditional economy has been sluggish.
The economy and the markets are in an interesting place right now. According to Raoul Pal, the overall economic cycle is subdued, especially in manufacturing. The ISM survey, which measures economic activities, shows that manufacturing is sluggish, even though GDP has been reasonably strong. This creates a strange dynamic. The real economy, especially traditional sectors like manufacturing, isn't growing as fast as expected. Unlike traditional sectors, tech companies don't rely on debt or real-world expenditures to drive growth. Instead, they thrive on cash flow from digital services and other derivatives. In short, while parts of the economy struggle, tech stocks are powering on ahead. It's clear that there is a divide between the old economy and the new one. My name is Michael Triumph and welcome to Crypto HC. If you're enjoying the video, please like and subscribe. The markets have seen some correction lately, with Bitcoin soaring to $108,000 before pulling back to $89,000. So what's next for Bitcoin? Stay tuned as Raoul Pal will break down what to expect this year and whether you should be feeling bullish or bearish on cryptocurrencies. My fellow crypto investors, if you enjoy reading, please subscribe to our newsletter. Now, enjoy the show.
However, my general construct is this year will be a good year. We will go to much higher valuations. And then after we've rolled the debt, we tend to tighten liquidity because the inflation pressures have come back somewhat. That tends to draw down the markets. We kind of reset again before we start this cycle all over again. My working hypothesis is this is going to be, valuations will get expensive this cycle. The correction may not be large, maybe just be a year of sideways, down 15% something. But the next cycle, because that's when AI, robotics, self-driving cars, missions to the Mars, all of this starts hitting, we will go to a full bubble cycle. And then we can think about what the world looks like after that. So I kind of think we're in a golden bull market, at least until the end of the decade.
And so if I speak to you in a year from now, do you have a target for the S&P?
It probably does another 20% from here.
That's good news.
Yeah.
So I can't have a discussion with you without discussing Bitcoin. I know you're very bullish in the long term, but I saw an interview you did recently and you think it's going to have a good year, but there's going to be a lot of volatility. Maybe you can just take us through your thesis.
So Bitcoin is also driven by global liquidity, but it's also the adoption of this new technology, which puts it in this stupid exponential secular trend, but with volatility. The big volatile drawdowns are just driven by liquidity. So this year, we've already established is a liquidity positive year. In fact, a very big liquidity positive year because you need to roll all of this debt. So generally speaking, it should be a very good year for cryptocurrencies. However, we're in this period where the Federal Reserve and the Treasury, and because of the dollar, have tightened liquidity over the last couple of months. It's forward-looking, so it's affecting cryptocurrencies right now. So they've been soggy for a while because liquidity was tightened a while ago. But again, our expectation is, it shouldn't last that long in price or time. And then we've got liquidity all the way through this cycle. Now, if we go back to 2021, the prior post-election cycle, because the pandemic had seen the global economy go down to zero, then go straight back up again, the business cycle peaked really early in April 2021. normally in these presidential election cycle years, the business cycle peaks towards the end of the year. So Bitcoin had a very complicated 2021, but what we're doing now looks very similar to the 2017 post-election for Trump. And what we saw then was ongoing injections of liquidity. We started the year with a sharp 30% correction or 25% correction, the sort of thing we're getting now. And then liquidity just came all year. And it wasn't actually massively put in by the US, it was actually China last time. And I think we might see that again this time, where China is going to play an important role in global liquidity. So I think it's going to be a much stronger year than people expect. People have a lot of PTSD from 2021, where it peaked early, then collapsed, then went back up again, then collapsed. I think it's going to look more like we saw in 2013, 2017. So yes, I remain very bullish for this year on all risk assets.
Raoul Pal predicts a strong year for markets, driven by liquidity and debt rolling. He believes valuations will rise significantly in the short term, but inflation pressures might prompt a tightening of liquidity later. This could lead to a correction, possibly sideways, or a drop of 15%. Over the long term, he sees a massive golden bull market. This would be fueled by transformative technologies like AI, robotics, and space exploration. This would then drive markets to bubble-like valuations by the end of the decade. Raoul Pal remains optimistic about Bitcoin, linking its performance to global liquidity. He anticipates a volatile year, similar to past cycles like 2017. In the short term, tighter liquidity may hold Bitcoin back. But as global liquidity increases, particularly from regions like China, cryptocurrencies are expected to gain momentum. Drawing parallels to 2013 and 2017, Raoul Pal predicts a stronger performance this year than many expect, driven by consistent liquidity injections that will boost risk assets.